Welcome to The Explainer. Today, we're cracking open the playbook used by the ultra-wealthy. We're not just talking about earning money, but about how they own, grow, and protect it for generations.
So we're going to break this down into 6 key parts. We'll start with the core mindset shift, then get into the nitty-gritty of the legal structures and the powerful mechanisms that make it all click. All right, let's get into it.
So first things first, we've got to understand a really fundamental difference in how the wealthy approach income and, of course, taxes. It's a total game changer.
I mean, have you ever wondered about this? It seems kind of backward, right? The answer isn't about how much money you make. It's all about how that money is made.
Okay, so look at this. Most of us, right, we live on the left side of this chart. We have jobs, we get a W-2, and we pay taxes based on a progressive system. The more you earn, the higher your rate goes. But the wealthy, they're playing a different game over on the right. They focus on portfolio income. And here's the kicker. The tax code is literally designed to encourage this. It's built to incentivize people to invest in the economy. So it's a huge shift from working for your money to having your money work for you.
So here's the thing. To make this shift work, you need a specific legal structure. You have to separate and protect your assets from all your liabilities. It's not just about what you own, it is all about how you own it.
And the pros, they call this the T formation. Think of it like a blueprint for your entire financial life. It's got 3 core pieces that work together to build this defensive wall around your wealth.
Picture it like this. At the very bottom, holding it all up, that's your trust. That's for the long haul, for your legacy. Then, on one side of the T, you've got your operational entities. These are your LLCs, your income engines. They're out there running your businesses. And on the other side, totally separate holding entities. These just own your appreciating assets, like real estate. This keeps them completely isolated and safe from the risks of your day-to-day business. That separation, that's the bedrock of real asset protection. Now let's get into the weeds a little bit, because this is where it gets really cool. Once your business is making a decent profit, say over 50 grand, you can make a powerful move by electing S-Corp tax status. See what happens here? Instead of paying self-employment tax on the whole $100,000 profit, you pay yourself a reasonable salary. In this case, 30 grand. That's what you pay the self-employment tax on. The rest, that's $70,000, that comes to you as a distribution, which is not subject to that same tax. That one move can save you thousands and thousands every single year.
Okay, now let's talk about the engine that really drives this whole wealth machine. It's one of the most powerful strategies out there for growing wealth without ever creating a taxable event. Some people call it buy, borrow, die. It's a simple, yet kind of mind-blowing 3-step dance. First, you buy assets that are going to grow in value. Second, as they grow, you borrow against that new value. Now, since a loan isn't income, that cash you pull out is completely tax-free. You can live on it, or you can use it to buy more assets. And then finally, you die. The assets pass to your heirs, and their cost basis gets stepped up to whatever the market value is on that day, which can completely wipe out a lifetime of capital gains tax.
And the magic behind this whole strategy? It all comes down to one key idea: unrealized gains. See, the IRS only cares when you actually sell an asset. As long as you just hold on to it, all that growth, all that appreciation is not a taxable event. It allows your net worth to just keep compounding year after year, untouched. Okay, so now let's zoom in on one particular asset class that is like a superpower in this playbook: real estate. It has some really unique advantages baked right into the tax code. And the absolute king of real estate tax advantages is something called depreciation. It's wild. The IRS basically lets you deduct the value of the building over time because, in theory, it's wearing out. This creates a loss on paper that lowers your taxable income, even while the property is putting cash in your pocket and going up in value. It's like creating a deduction from thin air. And this right here is a perfect example of playing checkers versus playing chess. Most investors, they just use the standard
Slow and steady straight line depreciation. But the smart money? They use what's called a cost-segregation study. This lets you break the property down into its components. We're talking carpets, fixtures, appliances, and depreciate those parts way, way faster. This pulls massive tax deductions into the first few years you own the property. Now here's where it gets really interesting. Normally, that paper loss from depreciation is passive, meaning you can only use it to offset other passive income. But, and this is a big but, there's this incredible loophole for short-term rentals that completely flips the script. If you meet two tests, your average guest stays for 7 days or less, and you materially participate in managing the property, you can reclassify those paper losses as active losses. That's the golden ticket that lets you use them to wipe out taxes on your main income. So what does this actually look like in practice? The numbers are just wild. An investor could buy a $600,000 property, do a cost segregation study, and after covering the property's own income, end up with a $90,000 active loss. A loss they can use to directly lower the tax bill from their main job or business? It's huge. Okay, now before you run out and try all this, we have to talk about the risks. Because believe me, this is high-stakes stuff. This is not a game for amateurs, and if you mess it up, it can go very, very wrong. And here is the #1 absolute golden rule you cannot forget. The investment has to make sense on its own. It has to have good cash flow, good potential for appreciation. Chasing a tax deduction into a bad deal is probably the fastest way to go broke. So let's break down the most common traps people fall into. First, not realizing that you can only depreciate the building, not the land. Second, getting so excited about the tax break that you forget to check if the investment is actually any good. And third, failing to keep meticulous records. If you get audited, you have to be able to prove everything, especially all those hours for material participation. Okay, so let's tie all of this together into one big picture. Because the real power here isn't in any single trick. It's about how all these strategies integrate and work together as a complete system. You see, the wealthy don't view the tax code as a burden or a penalty. They see it for what it is, a legal playbook full of incentives. The government wants people to provide housing, to invest in businesses, and the entire system is designed to reward the people who align their money with those goals. And that really boils down to a fundamental shift in mindset. It's about moving from that feeling of being stuck in analysis paralysis, being afraid to spend money, to having a bias for action, for implementation. It's understanding that paying for expert legal and tax advice isn't a cost. It's an investment in building your own wealth.
So ultimately, it all comes down to this one question for you to think about. Is your financial plan just about earning an income and playing defense against taxes? Or is it actively and intentionally structured to build, protect, and grow wealth for generations to come?